All right, great intro there. We're going to dive into it right now with a look at the kind of growth that MiFID II will allow, the kind of transparency that Tim was talking about, and how that's kind of fueled the asset growth here. In fact, according to Bloomberg, it could double assets as much as $2 trillion in the next 5 years. This new sort of umbrella regulation. We've got here with us one of the people that knows more about regulation than anybody in the industry, Nick Comfort from Bloomberg News. He's also got some panelists with him there. Carmen Gonzalez Calatayud there, Senior Product Specialist at HSBC, Michael Stanley, ETP Manager at the London Stock Exchange, and James Baugh, European Head of Market Structure at Citigroup. Nick, take it away.
Thanks very much, Matt. So as Matt mentioned, I'm a financial regulation reporter with Bloomberg here in Frankfurt. And as hopefully any readers and viewers of Bloomberg know, we like to speak to the best and brightest in any given industry. So I'm very lucky to be joined today by Carmen, who's a Senior Product Specialist at HSBC Global Asset Management. In practice, that means that she oversees the asset manager's commercial strategy in the passive space. We have Michael Stanley, who's the ETP Manager at the London Stock Exchange. He product manages LSE ETP trading service and got the platform ready for MiFID II. As if that wasn't enough, he also leads product development on both primary and secondary market offerings. And we have James Baugh, the European Head of Market Structure at Citigroup, who spends most of his time advising clients, helping them to understand the regulatory framework and how Citi can support them. And he used to work at LSE as well. As Matt mentioned, the $2 trillion figure that our Bloomberg intelligence analysts have come up with. Now, transparency and fees are two big factors cited there to what we're driving that. But something tells me that our panelists are going to tell us that reality is a little bit more complicated and exciting. So if it's okay, I'd like to start with you, Michael. Maybe you can give us just a view, sort of since the beginning of the year when MiFID II came into place. How have ETF inflows developed, and is MiFID II behind that?
I think we just talked about the broader offering. So the ETF market as a whole, we've seen monthly average turnover increase by 70%. If you look at the on-book, the order book volumes, we've seen those increase by about 24%, so slightly less, but a strong year. And obviously, it's been earlier on in the year, the volumes were pretty good with what was going on in the macro environment.
Okay, and I mean, Carmen, how much is that MiFID, and how much is that just a fundamental dynamic of the market? We heard from Vanguard before about this, the thrust behind it.
I think it's a bit of a mixed picture, and I believe both are contributors. Obviously, in the industry, for the last few years, we've been waiting for MiFID II to come into force, because obviously we all were looking forward to the transparency. As we approached the day of implementation, what became apparent is that it was slightly watered down, and we all started getting a bit more worried about what it would mean in the reality with the structures that you have, the MTFs, the internalizers, systematic internalizers as well, and how the reporting and the transparency of that reporting would work. I think what we've seen is positive, but it's not necessarily the boom that we all expected. And I think the fact that that the markets have behaved, in a manner which has been conducive towards ETF trading, also makes us a bit more skeptical if if we already have full transparency. I think there's still a long way to go. We've seen some positive steps. Clearly, there's an increase in volume, to Michael's point, but also clearly we know much more now what's happening in the RFQ market. But I think there's still a long way to go.
Mm-hmm. Okay, so clearly more transparency, but no big boom yet. I'd like to come back to that point of transparency and data, James, if I may. So we journalists, we love data. We give us as much as possible. But is there such a thing as too much? And do we actually have a true picture of liquidity in the ETF market?
Well, I think we all know the answer to that, and that is that we don't have a true picture. I think that to draw parallels or to look at MiFID II as the overarching factor to growth in ETFs in the first half of this year is probably somewhat fanciful. I think it's too early to call. It's evolving, and I think what we're realizing is that it is a complex landscape, and data is key, is important, But to have that consolidated view, and I'll be first to make mention of a consolidated tape in ETFs, because a lot of conversations we have with clients and internally focus on whether or not a consolidated tape would add value and is indeed something that could be practical in the sense of driving greater transparency. But what we're finding is not dissimilar to what we saw in the underlying cash market post-MiFID I, where we saw fragmentation, is that to actually develop a consolidated view of the market is difficult. And it's really down to the underlying markets themselves and the ability to provide that data at a sort of a sensible commercial level that allows for people to access that information. I would say that we've been doing quite a lot of work alongside Bloomberg to build out an aggregated view of the market where that data is available. So I think if you look on, I think it's the FRAG screen, I think is it QMC, you'll be able to see a consolidated view of some of the liquidity, but not all of the liquidity. So I think there's still a long way to go, and it's, as I say, to answer the question, the hope is that we get much more transparency, but it's too soon to call.
Okay. And Michael, do you want to jump in on that point? So who's going to be ultimately going to be compiling this data? Who's going to be coming up with a consolidated tape? And what would you like to see from ESMA, the markets regulator, in the run-up to that bright future?
I think obviously ESMA are going to offer it up, so at some point there will be someone imposed to actually take on that responsibility. So someone will take on that responsibility. Mm-hmm. Maybe that will be Bloomberg. We don't know who that will be at this moment in time.
Okay, but what would you be wanting to see from ESMA in the meantime? Then is there something which would really help to just a timeline in terms of giving what is you as a market practitioner? What do you want to see from the regulator to get a better grip on when that data will be coming out?
I think the regulator is doing what they can. Obviously, it's a massive undertaking to manage all of that data. I think Bloomberg are doing a very good job. I think, like, physically what I've seen at the moment, visually, is you've seen all of the established exchanges. That data is quite easy to get hold of. But for example, the MTFs like TradeWeb or even Bloomberg, to get it all in one space, like James was talking about, that hasn't quite happened yet. Mm-hmm. So I think it's maybe a wait and see how things progress within the market. But as I say, at some point, ESMA will have to, obviously say to someone to take on that responsibility or put in place an organisation to take on that responsibility.
Carmen, I could see you just sort of jumping in a bit there. So you, as an asset management company, you're willing to go the extra mile and compile data from across all kinds of different funds, but individual investors might not. So how do you, what's your view on that?
I think, for us it already, to get all the data is a cumbersome exercise, and I can understand that no investor wants to do it. I mean, to the question that the point you were trying to make earlier, what I would expect or hope is quite a quick recognition by the regulator that maybe what was intended hasn't been achieved, and maybe an engagement with the industry. I think one of the things, when I talk to my colleagues on the dealing desk who look after our execution strategy, and I look at cash equity, I look at bonds and everything, the one particularity I would say that we have in the ETF industry is that we slightly break the traditional operating model. So on the one hand, you have the sell side, our liquidity provider. On the other hand, you obviously have the buy side who buy our products. But in the middle, you have the provider who wants to make sure that the product is traded, that the secondary market works. And I think by having this tri-party, space, I believe that we might be in a position where, as an industry, if we engage with a regulator, we could achieve something where maybe previously something wasn't achieved. So I'm relatively hopeful, but what I expect, or what I would hope, is a quick recognition that maybe what was intended hasn't been achieved. So rather than wait for 5 years to bring out a consolidated tape, do it a bit quicker than that.
I would point out there's probably a long list of things that people want changed about MiFID, so it's going to be in the queue there somewhere.
Can I just add
please.
to this? I mean, I think that what we've got to appreciate is that the regulators had hoped that the industry would solve for this, and it hasn't. And there are economic reasons why that is the case. And there's a lot of finger pointing back to particularly the exchanges and the cost of data and being able to license that data for the purposes of building out these consolidated views. So I think that unfortunately we are going to see or have to see the regulators step in if the likes of Bloomberg are going to build out a consolidated tape and or other vendors, because it's not commercially viable.
Mm-hmm. Yeah. So to pick up on that point then, so who's standing in the way now? Is it the exchanges who are keeping a monopoly over data or making it too expensive?
I think, I can only speak to the past experience from the cash market, so maybe a little look back to think about what we might see in the future. And there's no doubt that the industry has had to solve this problem itself, and today we reference what we call an EBBO, a European Best Bid Offer, as a reference, as a benchmark. But that costs us money, and we have to take that data directly. Okay, so if you think about it in the context of a consolidated tape for ETFs, I just worry that there's going to be a lot of panel discussions about consolidated tape, and we're not really going to be able to progress this unless the regulator steps in and enforces a model that makes it economically viable.
Okay, so that's something which we'll be looking to in the future. But maybe, Michael, do you want to talk to us a little bit about systematic internalizers and whether, I mean, my first reaction as a journalist is to see them maybe as a threat for the traditional exchanges, but maybe you have a different perspective on that.
To be honest, I go back a step. I actually see ETFs, the way ETFs are traded, actually changing quite significantly. Obviously, ETFs are going to become more equity-like. I think trading in general is going to be more automated. I think we will see the rise of, for example, the ETF algo, which, from my understanding, is not really prevalent within the market today. I think all of these things will bolster order book volumes via natural liquidity being placed passively on the book. Obviously, the SI is a new setup. There are a number of SIs we've seen. James can obviously comment from his perspective. I don't think this is a threat to the exchange. I think it's complementary. I think I've talked about this in the past with, for example, RFQ mechanisms or whatever. If a market maker is making a price on an RFQ platform, in a lot of circumstances, they're going to have to hedge that risk. A lot of the time, that's done via the order book, for example. So I would say it's complementary to our overall market.
I'd like to come back to the request for quote platform in a moment, but maybe we can also talk a bit about the retail market, because I think a lot of what's behind that, those 2 trillion estimate from Bloomberg Intelligence, and also the hopes that we hope also from Tim at Vanguard, is that the retail market will surge up and be a big contributor. I may be biased. I live in Germany, where my neighbor thinks that me investing in the stock market is gambling and going to the casino. But Carmen, maybe you can tell us sort of whether you see how, if at all, you see the retail market supports fueling growth within ETFs.
I think that's going to be a more complex picture in Europe. As we've already mentioned, Europe is a fragmented picture, culturally slightly different. So you will have some countries that will have a stronger equity culture that are much more likely to embrace ETFs. You have other cultures that might have a stronger mutual fund tradition, and they might more go to the index funds that were mentioned earlier. So I think it's the development of the retail market, in my view, is still a mixed picture. There is a one of the points of MiFID II is also the ban on type of ban on incentives. That's clearly positive for passive overall. So I think as looking after a passive strategy, we already have seen significant growth, and we expect this to go even further in the retail space. But what we're also seeing is, and again, to the point that was made earlier, that be it a robo-advice platform, be it sort of this, what we would call solutions, wealth products, these are growing substantially for wealth. And those are the ones that are using ETFs or index funds. And I think that's where the growth is coming from primarily. So at the moment, if I had to venture, I would probably say 5 to 10%, might grow over time. But you might also find that instead of going directly to the ETF, they might go through the robo-advisor route, through a fund, a portfolio of ETFs.
Okay. Well, maybe then, James, should we go to the big boys and girls in the market, and the institutional investors and the more sophisticated investors. has there been more interest in ETFs as a hedging product since with the advent of MiFID II? Is that something where you're feeling that the people, since they have more data there, are getting more comfortable with it and wanting to be more active?
I think the short answer is we haven't really seen that yet. I think that there's obviously been growth in the early part of this year. As mentioned before, I don't think we can put that down to regulatory change per se, but there's obviously hope there that greater transparency will lead to that sort of level of comfort that you talk to, and we'll hopefully then start to see some additive growth and volume coming into ETFs.
Okay. And I mean, Carmen, so what is your impression then of, I mean, if you explain to most people that the E and the T stand for exchange traded, I mean, they would be surprised that in Europe so much of it goes over the counter. But what is your impression? Do you think that MiFID II will move us more from the OTC area into the exchange area, or is this something just going to be, this is just how Europe is from now and for all time?
I would like to be optimistic. I mean, okay. Let's take a step back. Exchange-traded funds, one of the reasons we're also enthusiastic about them, and one of the things that we associate with ETFs is transparency. And clearly, as a provider, what I want is the most transparency for my product. This I'm mostly going to get through the exchange. So obviously, from my perspective, I would love everything to go through the exchange. But the reality is we have an infrastructure which is not, at the moment, conducive to it. So I think MiFID II is trying to address some of these issues, but it's by no means addressing them all at this stage. So I think there needs to be quite a bit of development. If the final or the goal is that everything goes through exchange, a lot needs to happen.
Okay.
Just like to add to that point, actually. I think what we'll see, obviously today you see a lot of trading happening on the RFQ platforms. That's obviously a click-to-trade model. It's very manual. I touched on the point there about trading becoming more equity-like, using algos. I think longer term, you're not going to see someone doing 20,000 euros worth of DAX manually. I think that will be through an algo. I think that'll be done on the order book automatically. So I think you will see that trend back to on-book, away from RFQ platforms, as people start to use ETFs more and more. I just think that's going to take a little bit of time, but there obviously are a number of, for example, agency brokers looking at that enablement at the moment.
James, did you RFQ platforms, request for quote platforms? Is that something which you think will be? I mean, what's your client's view? Do you think they're going to be piling into that, or is it also just another layer of cost?
Well, I mean, I think it's interesting when we talk about the swing back to primary to on-book business. I mean, I think we need to understand that not all business is necessarily relevant for trading on a central limit order book. You don't know who your counterpart is. You've got to think about the cost of execution, and we all know that trading on venue is more expensive relatively. And there's also market impact to consider. I think are people focusing on RFQ platforms? I think clearly there's a highlight, the spotlight rather, has been on our RFQ platforms. They're now having to be regulated as multilateral trading facilities. My concern, I suppose, is multifaceted in the sense that what we don't want to see is further fragmentation. We don't want to see the market, if you like, commercialize the regulatory change by introducing just another RFQ platform, which isn't adding additive liquidity, that has the same makeup of market makers. And also, we need to understand that when you trade on an RFQ platform, you're paying a risk premium, right, for that instantaneous quote, particularly when you're looking across geographies or across assets. And there's reason for that, but actually it might not be the best outcome for the client. And when you think about MiFID II, one of the things that we've not touched upon is best execution. And my strong argument is that by trading on a single RFQ platform and taking the best price, that does not achieve best execution. And I think that's where firms like HSBC, like Citi, have a role to play by managing that agency flow, by managing client business and finding the best outcome. And it may well be that we can offer a better price for a larger sized block, where we manage the unwind, we manage the market impact. And that can be by then introducing algorithmic trading strategies to glue some of this liquidity back together. But yeah, let's not sort of kid ourselves that the nirvana here is everything going back on exchange and on order book.
Michael, go ahead.
Sorry. No, and I think you're completely right. I mean, to a certain extent, the transparency model that is offered by, or some aspects of the transparency model that is offered by the exchange, I think as a provider, that's what we're after, and we're coming back to the consolidated tape to a certain extent. I think the model that you're describing is probably the one that is going to be prevailing, but then you need to look at it, how you can design it in such a way that it offers the transparency that the investors would like.
And Michael, I'm sure you want to jump in on this one too.
So I think we talked, just to summarise it, I think we've got a gap between RFQ platforms and order books. I think what the exchanges are looking to do, especially LSE, is obviously provide a tool which bridges that gap. So you'll have like a winner-takes-all RFQ model or even an auction model, but also have like an order book suite to access, for example, hidden liquidity or even passive liquidities on the book. Obviously, these things take time, but you know, I expect the exchanges, including ourselves, to have this type of facility in the short term.
Mm-hmm. There's really a word which is crystallizing in my mind, which is fragmentation on all kinds of different levels. But maybe you want to talk to us a bit about regulatory fragmentation, Carmen, and what you'd like to see, I mean, if it's possible for us to have a more harmonized approach to regulation.
Ideally, we would like to see that, but I think it's going to be slightly difficult because each regulator might be focusing on slightly different aspects. Clearly, the regulators where our funds are based, such as Ireland or Luxembourg, they're definitely going to focus much more on regulating us as providers, whereas if you look at somewhere like Germany has some providers as well, but a lot of trading activity happens in Germany, the same as you would have in the UK, for example. Obviously, the focus is very different. It's on the liquidity providers. The focus is also very much on investor protection. Are we, is the market functioning in a way that is the right one for the people who come into the market? So I think the variation in interest means that it's going to be difficult to avoid in certain fragmentation within regulation. There will always be slightly nuanced interpretation of what ESMA comes out with, and I like to be an optimistic person, but I think on this one we will continue seeing that, I believe.
Mm-hmm. Okay, we're coming to the close of our panel now. Maybe we can each just give a closing thought and talk to us about what you expect to see in the coming months and what you would like to see in the coming months as we get to grips with MiFID and the consequences. Do you want to kick us off then, James?
Yeah, I think that despite perhaps being somewhat cynical in my responses, we do absolutely remain hopeful, and we think that regulatory change specifically for ETFs is positive in driving greater transparency. As we've also mentioned, I think we all have to come to terms with the fact that liquidity is fragmented and will continue to fragment. Like a lot of things in life across industry, you tend to see that fragmentation and then subsequent consolidation, but we're in that early stage right now. I think the other thing that we need to think about, and we heard from Tim in the introduction about the rates and trying to make these things as cost effective and as efficient as we can be. Unfortunately, we also have to understand that the cost of execution is only going one way. Yeah, because we as a business are not able to necessarily internalize as much flow as we would like, and therefore we have to externalize, and therefore where you have that fragmentation, there's a cost of gluing all that liquidity back together. So hopeful that more transparency will lead to growth, but we just need to keep in mind that the cost of doing business is challenging.
Michael?
I think just to reiterate the point, I think we will see exchanges such as ourselves bringing out these new RFQ platform tools. We are constantly speaking to the buy side, the sell side. The main feedback is automation, low cost, as James has just alluded to. So I expect to see these tools rolled out within the next 6 to 12 months.
I think from my side, I would very much agree with, in particular, with what James said about fragmentation. And I would leave one final thought in there. And as the provider in this panel, I consider it also our obligation to make sure that as an industry, we we engaged further to ensure that what MiFID was aimed to bring, MiFID II was aiming to, which is provide more transparency to the product, actually materializes as quickly as possible.
Okay. Well, I'm conscious of the fact that there are several issues we haven't had time to talk about today, and I'm sure that Matt will pick up in his panel as well. I mean, fees and retrocessions on the one hand, which a big topic, but then also in terms of the comfort that regulators have with the liquidity of ETFs as well. Maybe not all exchanges are as diligent as the LSE in terms of sort of having stopgaps in place and things which prevent horrible things like fat finger trades and others. But I'd like to please join me in thanking my panel for this interesting discussion. Thank you for your time.
Thanks very much, Nick. Great discussion there. You did cover actually a lot of ground, so I guess I don't have to deal with fragmentation in this next panel.